Hey everyone, and welcome back for another deep dive. We're going to be looking at, let's see, it's an article from mapsignals.com called Industrial Sector Capitulation is a Buy Signal. And it's by Lucas Downey, published pretty recently, February 27th, 2025. So, I mean, as you guys know, the markets have been, well, they've been a little crazy this year. And the industrial sector's been getting hit pretty hard. So what if, like, this downturn is actually, like a hidden chance to buy some great stocks at a discount?
Interesting.
Yeah, that's kind of what this article's arguing. So let's see what we can find.
Downey starts by saying 2025's been, volatile, to say the least. He even says something called DeepSeek fears are a reason why equities are going down.
Yeah.
And then there's, of course, like real-world economic concerns, right? So basically, it's enough to make anyone want to hide their 401k statements. Yeah, that DeepSeek fears thing is interesting. DeepSeek, as you may have heard of, sounds like some kind of powerful AI system like making predictions about the economy. And those predictions are really impacting how the markets are feeling. I think it really shows just how much AI is changing things, even on Wall Street.
It really does. But the article reminds us that, money doesn't just like disappear from the market. It just kind of moves around. So while the major indexes might be down, there's a lot happening under the surface. Downey points out that there's been like these massive rotations happening in the market over the last 3 days. And this has led to what he calls capitulation in some areas.
Right, capitulation. Like imagine investors just giving up, selling off everything because they're afraid. It's almost like a stampede.
Yeah.
And that can create opportunities. Think about it. A stock that was doing well, suddenly everyone's selling it. The price drops, even though the company might still be good. That's where you could find some real value.
Oh, I see what you mean. It's like they're so busy trying to get out that they don't see what they're leaving behind. And the article really emphasizes that, this capitulation, especially in the industrial sector. It could be a chance to buy low.
Exactly. Now, of course, there's always risk.
Yeah.
But when you see this kind of mass exodus, especially if it's driven by fear rather than, actual problems with the companies, it could be a sign that things are oversold.
Yeah.
It's about being a contrarian, going against the crowd.
The author uses this idea of money flows to find these signals. He's basically saying that by looking at where the money's going, we can get a better understanding of what's happening in the markets.
Absolutely. Money flows are like footprints in the sand. They show us what investors are thinking. Like if everyone's rushing towards one exit, you want to know why, right? Maybe it's nothing. Maybe it's a fire.
That's a great way to put it. So getting into the details, Downey says over 3 trading sessions, outflows were almost 3 times bigger than inflows. And he shows this visually. 648 equities sold off versus only 232 that were bought. And here's where it gets interesting. Almost 40% of those outflows came from the industrial and tech sectors.
It's fascinating what the author points out about the size of these sectors. So tech might have had a larger total outflow, but industrials is actually smaller in terms of the number of stocks, meaning the selling pressure in industrials was way more concentrated.
Okay, so it's not just how much money is leaving, but where it's coming from.
Exactly.
Got it. Downey then goes on to say that last Friday and Monday were huge sell-off days for industrials, like the biggest 2-day outflow in over a year.
It all points back to that capitulation we talked about. Remember, panic selling. It often leads to buying opportunities once things settle down.
So even though it looks bad, this destruction, as Downey calls it, might actually be a good thing.
Right. It's all about being contrarian. When everyone else is selling, that's when savvy investors start buying.
And he even says this is supported by historical data.
Exactly.
So Downey's wrapping up by saying that, volatility is just part of the market. But industrial sector capitulation has historically been a signal to buy. So are you ready to dive deeper into this world of contrarian investing? We'll be right back after a short break.
Okay, so we've talked about how this market dip could be a chance to buy low, especially in the industrial sector. But I'm curious, have there been other times where this kind of capitulation, actually led to big gains later on?
Oh, absolutely. Tons of examples. Like think about the 2008 financial crisis.
Yeah.
A lot of people panicked and sold off everything. But those who, had the courage to buy when everyone else was selling, they ended up doing really well in the long run. Of course, 2008 was a pretty extreme case. But it just goes to show that sometimes the best opportunities come from those darker moments. That makes sense. So if we're looking at industrial specifically, what are some things investors should think about when trying to find those, undervalued companies we talked about?
Well, the first thing is to look for companies with strong fundamentals. Things like a healthy balance sheet, consistent revenue growth, and a competitive edge in their industry. You don't want to just buy something because the price is down. You want to make sure the business itself is solid.
Right, so it's not just about getting a bargain, it's about finding a bargain with potential.
Exactly. And that's where research comes in. You got to look at their financials, read industry reports, try to really understand their long-term prospects. If you believe in the company's future, then a dip in the stock price could be a great opportunity.
You know, it's funny, everyone talks about buying the dip, but it always seems easier said than done. It's hard not to get caught up in all the fear when everyone's selling.
Oh, absolutely. It's human nature to want to follow the crowd. But as investors, we got to train ourselves to think differently. Remember, the market often rewards those who go against the grain.
So how do we avoid getting swept up in all that? Like, how do we make sure we're making decisions based on logic, not fear?
That's a great question. And it's something, honestly, I think every investor struggles with. One thing that can help is having a clear investment plan. Like, decide in advance what you want to invest in, how much risk you're comfortable with, what are your long-term goals. That way, when the market inevitably dips, you'll be less likely to make impulsive decisions.
So it's like having a roadmap, so you don't get lost when things get, bumpy.
Exactly. It's easy to get sidetracked when there's so much noise and chaos. But if you have a plan, you can stay focused on where you're going.
Makes sense. So what are some things our listeners can do to start putting these ideas into action?
Well, first, don't be afraid to challenge your assumptions. Just because everyone else is doing something doesn't mean it's right for you. Do your own research, think critically, form your own opinion.
Basically, don't be a sheep.
Huh? Right. And second, remember that knowledge is your most powerful tool. The more you understand about the market, the better equipped you'll be to make good decisions. So, read books, listen to podcasts, never stop learning.
Great advice. And we've been talking a lot about industrials today, but these principles apply to any kind of investment, right?
Oh, absolutely. Stocks, bonds, real estate, anything. The key is to understand the fundamentals, assess the risks, and make decisions based on your own goals.
You know, it's funny. When we started this deep dive, I was actually feeling kind of anxious about all this market volatility. But now, talking about it and breaking it down, I'm actually kind of excited.
I love that. Remember, the market will always have its ups and downs. But for those who are prepared, those fluctuations can be amazing opportunities.
So it's not about avoiding the roller coaster. It's about learning to ride it.
Exactly. And remember, you don't have to do this alone. There are tons of resources out there to help you learn.
That's a great reminder. So as we wrap up this part of our deep dive, anything else you want to add about navigating this current market?
Well, I think the most important thing is to stay focused on the long term. Don't get distracted by the day-to-day noise. Or let short-term changes derail your goals. Remember, investing is a marathon, not a sprint. And as long as you're patient, disciplined, and keep learning, you'll be in a great position to succeed no matter what happens.
That's a great message to end on. Stay focused, stay disciplined, never stop learning. You know, it's kind of funny. We talk about the market like it's this separate thing, something outside of us. But really, it's kind of a reflection of us, isn't it?
It really is. The market driven by, human psychology just as much as economic factors.
Yeah.
And understanding that human element is so important.
So when we see all this volatility, the panic selling, it's really just our own anxieties playing out, right? But like on a huge scale.
Exactly. When fear takes over, it can spread like wildfire. But, the same can be said for confidence. When people start seeing opportunities, when they believe in the future, that optimism can spread just as quickly.
Okay, so let's talk about that. We've been exploring this idea of capitulation, how fear can create buying opportunities. But what are some signs that maybe things are turning around? Like what shows that confidence is coming back to the market?
Well, one thing to look for is a shift in money flows. When we start seeing more money coming into the market than going out, that's usually a good sign. It means investors are getting more bullish, more optimistic.
It's like watching for those first birds, the ones that start flying back to the forest after a storm.
Exactly. They're the ones who sense that the danger's past, that the sun's about to come out. And often, they're the ones who benefit the most.
Okay, so let's say we start seeing those signs. What are some things investors can do to, be ready for that next upswing?
Well, first of all, I'd say having a plan is key. Knowing your goals, your risk tolerance, your time horizon, it helps you stay focused. And avoid making those impulsive decisions based on short-term changes.
So even when things are looking up, don't abandon the roadmap.
Exactly. Stick to the plan. Don't let emotions get in the way. And second, be selective. Don't just buy everything that's going up. Remember, not all stocks are the same.
So it's like going to a buffet. You don't just pile your plate with everything. You choose what you actually like, right?
Ah, perfect analogy. Do your research, find those good companies, focus on quality over quantity.
Great advice. So as we're wrapping up this deep dive today, what's one final thought you want to leave our listeners with?
I'd say remember this. The market is a journey, not a destination. There will always be ups and downs, twists and turns. But as long as you stay informed, stay disciplined, and keep learning, you'll be well equipped to handle those challenges and ultimately reach your goals.
That's a great way to put it. So thanks for joining us on this incredible journey today. We hope you've learned some valuable things and feel more confident about facing the market no matter what happens.
My pleasure. And remember, we're all in this together.
And that's a wrap on another deep dive. Until next time, keep exploring, keep learning, and keep diving deep.